Good afternoon and welcome this afternoon to Trading Covered Calls and Cash Secured Puts, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, filling in today for Cameron May. Joining me out there in the chat is my good friend and 20-plus year veteran of the financial markets, Brent Moores. He's there to help answer your questions, and we are especially grateful to have all of you here with us as well today. Whether you're watching in the live version or the recorded version, we're glad to have you with us. Participate in the conversation, be a part of the chat. Brent's there to help answer those questions. If you're watching in the recorded version, leave us comments in the comment section, and we respond to those as quickly as we can. So over the weekend, I was watching the movie Blues Brothers with Dan Aykroyd and John Belushi, and the theme song that they sing when they go to the country western bar was the theme song from the TV show Rawhide with Clint Eastwood. It's the only song, the country and western song they know, and they sing it over and over and over again. And one of the lines in that song is "Rollin', rollin', rollin'." So that got me thinking about covered calls this morning and talking about the idea of rolling a covered call. So I had the idea to come up with a discussion of 3 possible reasons to roll an at the money or close to at the money covered call strike. And we'll see what that looks like. And I've got one bonus. So we're actually going to look at 4 particular examples of the idea of why we might roll a covered call. So before we do that, a couple of quick housekeeping items. We'll jump into this discussion. Remember, they're going to talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. We're going to be using technical analysis as part of this discussion. We're going to be using probability analysis part of this discussion. None of those are guarantees as to what's going to happen in the future. In fact, no method of analysis is a guarantee of what's going to happen in the future. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Remember, investing involves risk, including the loss of principal. Now, one thing to pay attention to today, specifically because we are going to be talking about one example where our short option is already in the money. Remember that short options can be assigned at any time up to expiration, regardless of whether they're in the money, at the money, out of the money. It doesn't matter. We're talking about the likelihood of that happening because that's part of this discussion. Now, we're talking about American-style options in this particular case, which can be exercised prior to expiration. European-style options cannot be exercised prior to expiration, and that's where you run into things like index options in a lot of cases. Now, one other thing to think about is we're going to be using the thinkorswim desktop software platform today, specifically the paper money version of that platform. And the paper money version of the thinkorswim desktop software platform does not facilitate the early assignment of short options. So there might be circumstances where you are practicing a strategy and maybe practicing a rolling strategy using the paper money platform, and it does not assign that short option early, where in a live account, there is a possibility that could, in fact, happen. So just be aware of that difference between paper money and live trading. It's still a great way to learn, still a great sandbox to practice in. It does not, however, guarantee future success out there in the real world. Now, a couple of other things that we might pay attention to. Remember, if you're going to put a stop loss order on a covered call transaction, make sure that the stop loss includes an order to close the short call first prior to selling the underlying stock so that you don't run into an inadvertent naked short position. Second, remember that stop orders do not guarantee the price at which that order gets filled, and a stop limit order has the possibility of being gapped around and may not fill at all. Now, one other mention here, and that is rolling strategies can entail additional transaction costs. They're not magic wands, and they depend on liquidity in the target date and strike in order for that roll to actually get filled. It's not a guarantee. It's not a magic wand, like we said. So we'll talk a little bit about that in this discussion today as we get into this structure of covered calls. So let's do this. Let's pop back over here to the thinkorswim desktop software platform, and we'll jump into our cash secured puts and covered calls section. And I've got 4 examples here for you, like I said, in terms of this discussion. And once again, you've got that great support out there in the chat from Brent Morris to help answer those questions. I'm going to just say this while we're right here on the thinkorswim platform, brand new. Click on that subscribe button down at the bottom of the page. That is going to be a great way for you to stay connected to the Trader Talks webcast community, to get that content popped up to the top of your YouTube feed as well as others. And you can also set alerts and a few other things. So a couple of quick questions that have just popped up in the chat as we've been talking that I wanted to kind of address here along the way. Yeah, there you go, Emotion, for sure. Hi, Renee. Yes, and you got it exactly right. Okay, so Ronald asks the question, can a put be sold, or can a sold put be exercised after hours on the expiration date? And the answer is there is a time window after the market closes in which an exercise notice can be sent. So there is a time there, and generally that's about 15 minutes where that notice can be sent. So there is a possibility that circumstance can happen. So that's something to pay attention to, is that, you know, you may go into expiration thinking, hey, all is well, and then somebody could either fat finger an order or press the button to exercise or make an irrational decision, or because there is news that comes out perhaps after the market closes, but within that time window, they could choose to make that decision. So that's something to pay attention to. And one of the reasons why we'll talk about rolling a covered call. So I've got 3 circumstances plus a bonus, like I mentioned. I'm just going to open up my left-hand side here and my scratch pad, and I wanted to show you. So these are the 3 plus the bonus. So the first one is close to expiration. One of the reasons for rolling a covered call is that that short call position is now very close to expiration, meaning within, say, for instance, 7 days of expiration. That may very well be a reason to close the trade down. Now, if you've been in my live workshops, you've heard me talk about this. We've talked about it before in different webcasts, but there's kind of a psychological challenge that a lot of options traders have to closing a trade down that may be out of the money or at the money even, or close to the at the money position when it's close to expiration. Thinking, well, I'll just save on the transaction costs and not close the trade down or move the trade at that expiration. I'm just going to let it expire worthless, and then I'll sell another one. And that way I don't have to sacrifice any of the premium that I potentially brought into the trade. So we're going to take this first one as our first example. That is a option that we've sold, a call option that we've sold against stock, covered call, that is close to expiration, that is just about at the money strike, maybe a little bit in the out of the money position. And we'll see what that looks like here in this particular case. And so this will be a good way to kind of get us started in this discussion. So that's ExxonMobil. If we come over here to this particular group that I have, here's our ExxonMobil trade. We're long 100 shares of the stock. We are short 1 covered call. We are short a call option in this particular case. It is a covered call because we own 100 shares. We are short the call. That is the inherent position. We are short the 29 August 115 strike. The stock is currently trading at 111. So it's come back down just a little bit in the last couple of days. So it was kind of sitting, when I was looking at this last week, kind of sitting right at that at the money strike. It's backed off just a little bit. But nevertheless, this is still an option that is out of the money slightly. It's pretty close to that at the money strike, depending on the number of strike prices and the strike increments that we have. And we originally sold this particular call option for $1.30. It is now trading for a little over a nickel. And so in this particular case, we're going to look at potentially rolling this. So we're going to focus on a number of things in making this decision. So Mr. Jerry asks a question: what delta would be good to sell a covered call in terms of selling an in the money covered call? Well, we'll talk about that. We'll talk about selling an out of the money covered call. We'll talk about some of the reasons for that. But that gets into the kind of the methodology of a covered call in general. In this particular case, we own the underlying stock, which doesn't expire, to Kelly's point, for sure. But now we might think, okay, well, cool. I've got 4 days left to go until expiration, right? We've got 4 days left in the lifespan of this option. The price of the stock's not necessarily likely to go to or above 115 in the next couple of days. It could, for sure. And it's done the majority of the work. So I could just leave this. That would be the thought process. I could just leave this call option in place. Let's look at the chart really quickly in this particular case. So this is XOM, ExxonMobil. So here's ExxonMobil. Here's our 115 strike, kind of way up here, right? That's our 115 strike where we sold that call option. I'm just going to label that real quick so we can see it. That's 115 right there. That's the strike that we sold. And, you know, you can see that the stock's generally been in kind of a downward trend overall, or at least some downward consolidation. I can right click and we'll activate that. We'll kind of extend that line down here, and we can see that it's made that move to the upside and then kind of come back a little bit. And then it's now maybe staying above that diagonal trend line. So we're still bullish on the stock, still a reason to own the stock in this particular case from a theoretical technical analysis perspective. But the likelihood of the price of the stock filling this gulf between where our short strike is and where the price of the stock is currently trading is a relatively low probability. So some traders might be thinking, okay, well, I'll just let this expire worthless because it's got only 6 cents left to go. And there's the possibility, let me kill that annotation, that, you know, it could go up, but it's a low possibility. So I'll just leave it. Well, here's the reason potentially why a trader may not want to leave this, but may in fact look at rolling the trade in this particular circumstance. Because it is near that at the money position. Remember that the at the money option generally is going to have the greatest amount of extrinsic value. And what is it we're selling truly when we sell a call option or when we sell a put option, either case? We're selling extrinsic value. That's the part that decays away based on time. That's the part that changes based on implied volatility changes. It's that extrinsic value that we're trying to capitalize on. If we sell a lot of intrinsic value, meaning we sell an in the money option, well, then we're just selling our own kind of inherent or intrinsic value in this case. So we may not want to think about doing that. But we go back to the monitor tab in this specific example here, where we've got about 6 cents of extrinsic value left. So this is the point at which we might think, could I roll this? And would I be able to bring in some additional premium? And what would be the advantages of rolling? Well, let's take it from the standpoint of saying, I'm just going to let this expire worthless first, and then I'm going to sell another one. The thing is, there is still, despite the fact that there is this distance, right, between where the strike is and where the price of the stock is, the fact is that is a pretty low probability that it's going to get hit, that it's going to end up at the money or in the money, that 115 strike. But it's not zero. So the price of the stock could go up on news. We don't know that. And that could erase all of those gains that we've made in selling that covered call. So if that's the case, we're taking on a fair amount of risk here, the risk being that the stock is called away from us, or that we have to buy this back for a lot more if we wanted to eliminate that obligation, in the occurrence that the price of the stock did make a move on news, or it was fat fingered and somebody placed an order and sent us an assignment notice. Now, it's not them specifically, it's the OCC doing that randomly. So this might be an opportune time for a trader in a circumstance like this to roll this trade. And I'll tell you why. We go back to the monitor tab. We say, let's create an order to roll as opposed to close this one down, wait, and then sell it, or just let this one expire and then sell another one. We're going to keep this rolling. We'll get these doggies rolling for sure. The reason is that we have an opportunity now to sacrifice just a little bit, but keep the trade intact and really kind of keep that premium stream coming in as opposed to taking that risk, because we're taking the same amount of risk of assignment here for the sake of 6 cents. Why not, if we're willing to take that risk, do it for more money? So we're going to right click and we're going to create a rolling order. Now, by default, the Thinkorswim platform selects automatically a roll to the next expiration. So the next expiration date is September 5. So here's the thing. Now, if we're just rolling out to that next week, and that's a weekly option, to that next week, net credit in this particular case is only 21 cents. And this is where a lot of traders get caught, because they press that rolling order button, and this is what you end up with. And they say, well, that's just not worth the squeeze here. I'm just going to let it expire, and then I'll look at selling another one. But what they're neglecting to realize is this is something that can be changed. We can change the length of time in which this rolls simply by selecting a different expiration. Now, it might very well be helpful, rather than doing this right here, to do a little pre-work prior to the roll. So we're going to go back to the trade tab here in this particular case. So here's the one that we're short. And we can see that position right here. We can see how much extrinsic value it has. It has no intrinsic value remaining. I'm going to add one other column just to satisfy a couple of people's questions, and that is we're going to add delta into this mix. So we're going to add delta, and we're going to click on OK. Now we've got a delta column here. So that's about a 6 cent delta. And that you can see why, because there's no extrinsic really. There's 6 cents of extrinsic. And that ends up kind of matching up with the remaining amount of extrinsic value now that we're 4 days to go. But the thing about this is the gamma on this option, and this is, I don't want to digress into gamma too much in this particular discussion, but if the price of the stock starts to move, this delta becomes pretty quickly higher than it is right now. If the price of the stock were to start to move to the upside, that becomes a little bit higher delta. Now that option becomes more directionally sensitive, and it could get us in the last 4 days. So now what we might do, though, is look over the horizon a little bit and say, where could we get a little bit more premium in order to keep these doggies rolling? So I'm going to look out now to the 19th September. And the reason I'm looking at the 19th September, I'm just kind of going out through this list of the implied volatilities over here on the right-hand side. And I see that that's the one that has maybe the slightly more elevated implied volatility in this particular case. That's probably going to give me a little bit more extrinsic value, a little bit more premium. So I'm going to open up that option chain, and we're going to look at the 115 strike. Now I know that I've got to buy back the one that I'm short already for 6 cents, which means that's going to give me about 78 cents, roughly, of 78, 79 cents of premium to roll to the 19 September expiration. And that's not too bad. I mean, that's pretty close to the one that we sold already. The reason I say that that's not too bad is because if we were to accomplish that roll, so I'm just going to bring my order back up, the one that we had created, and we'll roll this to the 115 strike for the 19 September expiration. That's the one that we were just looking at. Okay. So given the fact that bid-ask spread's a little bit wider, not huge, we may see 78, 79, 80 cents of credit, net credit, meaning buying that one back and selling the next one, 80 cents credit. We're at the same position. Here's the thing. If we go back to the chart and we roll this, we're at the same position. There's still the same gap between where the price of the stock is and that 115. But if it were to go up and we were to be assigned or called out, now we're bringing in a little bit more premium rather than holding on to that for 6 cents. So make sure that if there is that possibility that the stock is going to move up and you're going to be called out, then in this particular case, yeah, this is the idea. We're rolling it, and going back to Ricebird's comment, we're rolling it for a credit or just forget it. Yeah, at 21 cents, maybe we would forget it because it's not giving us much credit. In this particular case, 80 cents is giving us enough that it may be worthwhile hanging on to that potential upward risk in the trade. So that's one reason to roll. And so the reason for this one is that this option is close to expiration. So let me show you how we're going to go ahead and accomplish this. We're just going to bring that order up. And what we've done is we're setting up an order to roll from the 29 August to the 19 September. Now, this is just simply rolling them straight out, right? Roll them out. And we're rolling straight out. Could we roll to a higher strike? Yes. Could we roll to a lower strike? Yes. We'll talk a little bit about that here in just a minute. In this case, we're just going to roll straight out. And we just want to check. I'm going to go back to that trade tab. And we're going to check a couple of things here. I'm going to check this one. I'm going to check volume and open interest. And so if we roll to that 115 strike in the 19 September expiration, we roll to this strike, a lot of volume, a lot of open interest, that 115 strike, which makes sense because that's been resistance before. So we've got a good liquid target. The bid-ask spread is only 4 cents wide in that particular case. So that is a good liquid target potentially to roll to here in this particular case. Not a recommendation, but an explanation of why a trader might consider rolling an order when that trade is close to expiration, rather than take the same amount of risk for a very, very small potential return. We're going to increase the return, reduce the risk of being called out, because now there's more extrinsic value. It's not as likely to be called out, even if the price of the stock were to make a move quickly right now. And if the goal was to retain the ownership of the stock, doing this, clicking on confirm and send, reading through this order, which is a roll. And remember, not a magic wand. We're closing one, we're opening another, that's it. Make sure that this is what we want to do and that we're aware of any alerts that might exist here. And we're going to go ahead and we're going to send that one off. And we'll see we accomplished that roll. Rolled it for 80 cents net credit, which is we bought back the one that we sold originally. We sold another one. So that is number one. That is the number one example here, close to expiration. So we have accomplished this one. So let's just put a big X there. We've done that one. Now let's go to the next one. This is a certain circumstance where it's maybe a little bit different. This is where an option has been sold. The price of the stock has made a move. Now that option is deep in the money. There's not a lot of extrinsic value left, but we're prior to that point at which it is more likely to have that option assigned. Now, assignment can happen. Early assignment can happen anytime we are short an option. But where is it more likely? If we're deep in the money, if we're close to expiration. So let's look at the example here. Let's go to our monitor tab. That was ExxonMobil. Now let's take a look at ADI, Advanced Device, or I don't remember the name of it. Let's take a look at the chart real quick. ADI. Analog Devices. That's it. Analog Devices. So notice this is one that we sold up here when it was bouncing into resistance. It pulled back a little bit. It has now broken out on the earnings announcement. Implied volatility has dropped, which is great because that's decreased the value of that option to buy it back. But we're still deep in the money. Let's take a look at where we are. So in this particular case, on the monitor tab for ADI, we are at the 245 strike. Stock's currently trading at 253. So it's couple of strikes in the money here. We originally sold it for $4.55. Okay, $4.55. It's now trading at $9.60, but we've also picked up a fair amount of intrinsic value in that stock because the price of the stock's gone up. So we maybe want to preserve that value. Now we're 4 days to go until expiration. Here's the thing. If we go back to the trade tab and we look at this one, let's change this to ADI. And here's the one that we are short on ADI. Well, that's still XOM. ADI, there it is. Okay. Notice if we change our layout back to intrinsic and extrinsic, that this is an option, the 245 strike, the one that we're short, that really only has about $1, and it's actually increased a little bit since I started talking about this morning. Only has about $1 of extrinsic value left, but that is still a fair amount of extrinsic value. And at this particular point, if an option buyer were to choose to exercise their right to put a long call option, the long 245 call option into effect, they were to choose to exercise their right to buy the stock at 245 and convert that into long shares of stock, which means that we'd get an assignment notice and have to deliver those shares. That option buyer on the other side of the transaction is sacrificing about $1 worth of extrinsic value. Now, notice how this is bouncing up and down pretty quickly as the price of the stock makes smaller moves. There's a reason for that. The reason that extrinsic value is bouncing up and down quickly is because now 4 days to go until expiration with a high delta, this option now moves around a whole lot. So that may be the other reason in this particular case where we've got an in-the-money option where it's lost most of its extrinsic value, where we might consider as an option trader, as a covered call trader, to roll this option. Because what that does is it gives us more extrinsic value. So let's see how we could accomplish the roll. Now, in this particular case, if our goal was to have the shares called away, we could roll straight to the same strike. We could just roll it out longer in time. And that's going to decrease the probability of early assignment. But we could also kind of work this strike price up a little bit. Let's see what that looks like. Because if we go back to the chart, again, remember, it's broken out. We could roll that strike price up a little bit from the 245 that we sold at that resistance level. So we go back to the trade tab and let's kind of see, once again, maybe go out to where there's some elevated implied volatility out here to the 19 September expiration. And I'm telling you that probably the reason why this is elevated implied volatility at that 19 September is because that's when I believe the FOMC meeting is happening. And so overall, those strike prices that expire then generally have a little bit more implied volatility kind of baked into them at that point. If we were to roll out, here's the thing. If we were to roll out to the 245 strike, straight out to that 245 strike, we'd have to buy back this one for $9.50. That's what it's trading for right now, $9.60 roughly. But we could sell this one for $12. It's still got a fair amount of extrinsic value. So we're really just taking our intrinsic value and transferring that, and we're adding some extrinsic value, which is going to decrease the likelihood that we're going to be assigned this deep in the money. So we could keep this going for a little while. Now, there is the possibility that at some point, an option buyer could just say, you know what, I don't care. I just want to own the shares. Maybe ahead of an earnings announcement, especially ahead of a dividend payout, maybe ahead of a shareholder meeting. Those are all reasons why somebody might choose to exercise their right to buy the underlying stock, and then we'd get an assignment notice. So given that scenario here, and the fact that they're less likely to sacrifice $3.29 of extrinsic value than they are to sacrifice $1 of extrinsic value, we're going to look at rolling straight out. Now, we could also, like I said, we could roll out and up a little bit. So the next thing that we want to do in this particular case is check liquidity, check the target for our roll. So we're going to change our layout once again in this particular case to volume and open interest. If we were to roll to the 245, it's got a fair amount of open interest here. Not a lot of volume trading today. I'm not so worried about volume, much more worried about open interest in this particular case. That's the size of the pond that we're swimming in. And we're trading one contract. So one contract in 326 contracts is a pretty small fish in a medium-sized pond. If we were to roll to the 247 and we were to roll one contract, then we are a bigger fish in a smaller pond. If we were to roll to the 250, then we are a really small fish in a bigger pond, but we're not going to get as much for that roll. In fact, it's not going to cover the extrinsic or the intrinsic value that we are transferring. So that might run into a situation where we might not get a credit for the roll. But if our expectation was that the price of the stock was maybe going to pull back a little bit, that might be okay. If that is our expectation, though, we might want to consider the overall strategy at this point. If we think that it's going to break out and then pull back, we may not want to hold on to the underlying stock. So we're going to roll it for a credit or just forget it. I'm going to roll straight out to the 245. So we're going to come back to our monitor tab. We're going to right click and we're going to create a rolling order. And we're going to roll out to, once again, we're going to change this to the 19 September expiration, and we're going to roll that for a $2.75 credit. Not as much as we got to begin with, for sure. But one of the things that we've done here is we've decreased the likelihood that we're going to get assigned in this current expiration cycle. We've brought in a little bit of credit, brought in a little bit more extrinsic value, and we've kept the trade going. Now, consider doing this if our goal was to have the stock called out. And if there were more liquidity and a little bit more extrinsic value, this is essentially the definition of kicking the can down the road for a little while until maybe there's more extrinsic value, a little bit more volatility that would allow us to dig our way out of that in the money strike. So we're going to click on confirm and send, read through this order, make sure that this is what we want to do. We're going to roll to open and to close. We're buying one back. We're opening another one. Make sure that we're aware of that. We're going to bring in that credit. And again, make sure that there are any alerts that we need to pay attention to. And we got that for $2.75. So that's reason number 2 for rolling. So we'll put a big X there, deep in the money. Now, the third one is that the price of the stock is close to the strike price. Now, when I say close to the strike price, I'm talking about within 1 or 2%. So this example happens to be Disney. So let's bring this up. Let's go to DIS, and we'll take a look at where we are here. In this particular case, I got a bunch of positions on Disney. In this case, we'll go to the chart, and we'll bring up DIS. So this reason for rolling is that the price of the stock is very close to within 1 to 2% of the strike that we sold. It's not in the money in this particular case, but it's pretty close. So we would call this maybe the at the money position. So the stock currently is trading at about 118. And we've sold in this particular case the 120 strike. Now, that might be pretty close to our at the money strike. This actually pulled back a little bit from where it was when I was putting this together this morning, pulled back a little bit from where this was on Friday when I was first starting to plan this and talking about this. So things have changed, and things always change. That's the nature of a dynamic market. So let's go back to our monitor tab. Let's see where we are with Disney. Here's our Disney trade, 11 days. So we've got a little bit more time to go here. 11 days to go until expiration. We originally sold this option for $2.85. It is now trading at 96 cents. So it's done some of the work that it can do for us. In fact, it's done a little more than $1.85 of the work that it can do for us in this particular case in terms of decaying away, melting away. Now we're short the 120 strike. Now, why potentially would we roll given the fact that our strike price that we sold, the 120 strike, is within that roughly 1 to 2% range of our strike price, our stock price? And the reason is, again, the behavior and mechanics of an at-the-money strike. So remember, an at-the-money strike is going to be the strike that's almost always going to have the greatest amount of extrinsic value. So here's the one that we are short. Now, like I said, there's a couple of, because we've got dollar-wide increments here, this option is a little bit further out of the money. Doesn't have extrinsic value, or intrinsic value in this case. But if we were to go out a little bit, let's go again to where maybe we've got some elevated implied volatility. Let's go out to that 19 September expiration. You're seeing a theme here. And we go right out to that 120 strike. You notice that this one has about $1.84 of extrinsic value. So we could keep this trade going. We're rolling to the strike. Now, the other thing that we could do is we could roll this in a little bit. We could roll this back down, cut them back in, according to the song, with that expectation that maybe this is going to roll into a little bit of a pullback from this 118, 120 resistance level and bring in a little bit more premium. So our goal is to have the stock called away anyway. We could roll. And now notice we've got a number of strikes here that have a fair amount of liquidity. The 120 strike out here has a lot of liquidity. One contract's going to be a very, very small fish in a very, very large pond. But even if we're trading one contract at the 118 strike, this would be the exception to maybe rolling back down and expecting that the price of the stock's going to pull back a little bit. So we're going to go to our monitor tab and we're going to roll back to the at-the-money strike to collect that richer extrinsic value at the at-the-money strike. So in this particular case, right click, create a rolling order, and now we're going to adjust this down. We're going to go out to the September 19th expiration. And so by doing that, our net credit's going to be 91 cents, but we're going to make that a little bit better because we're going to roll this down to the 118 strike. And now we're going to bring in $1.81. So net now new roll, $1.81. That goes on top of what we paid already for, or what we were paid already for selling this strike price, or the 120 strike price to begin with. And that's going to help to offset maybe a little bit of that pullback that we might see in the underlying stock. So the number 3 reason here in this particular case for rolling would be that the price of the stock is close to the at-the-money strike, and there's a lot of juicy premium to be had at that particular level. Now, if you want to keep the shares, you could stay rolled out to that higher strike, or we could split the difference and go to the 119 strike and still bring in a fair amount of premium. So, Greg, I'll go with you. I'm gonna split the difference here between the 120 and the 118 strike, and we'll sell the 119 in this particular case, still getting $1.32 on this particular case. And we're going to click on confirm and send. We're going to read through the order, make sure that we're aware of the transaction costs, not a magic wand. Make sure that we know what it is that we're accomplishing, any alerts that we need to pay attention to, and we're going to send that order off. And we rolled it for $1.32 net credit. Again, keeping with the roll it for a credit and just forget it. Now, Mark asks a great question here. The wisdom of rolling from a monthly option to a weekly option. From a mechanical standpoint, from a behavior standpoint, they're exactly the same. A weekly option is just an option that expires on a Friday that is not the third Friday of the month. Where you may run into an issue in this particular case, is liquidity. And sometimes, depending on when that weekly option has been issued, because those are going to be issued on a more frequent basis, there may not be a lot of trading that's already happened on those weeklies. So that's something that you're going to want to pay attention to, which is why we check that volume and open interest to make sure that there's a liquid market there in the target for your roll. But the difference between rolling to a monthly or rolling to a weekly, it very well could be that there's no liquidity in the monthly as well. So good question to ask, and it's a good reminder to check that. Now, Adolfo asked the question, well, I don't have commissions on this rolling order. Commissions are always negotiable. Commissions are something that that in this particular demonstration account I've taken out of the equation, but rolling orders do not eliminate transaction costs, right? And so you are going to have transaction costs. We've just taken them out so that it doesn't cloud the issue here in this particular case. All right, the bonus. So that was the third one. So these are our three reasons: close to expiration, deep in the money, close to the strike. Now, here's what we're going to do. We're going to do this really fast. Ahead of earnings. So let's go to the chart. I'm going to do this really quick. NVDA. I know a lot of people are paying attention to this. Here it is. The earnings announcement's coming up at the end of the week. Something to pay attention, or middle of the week, and a lot of traders are paying attention to this. We are short in this particular case. This one right here, we are short the 185 strike. Stock is currently trading at 181. We're short the 185. Why would you roll ahead of the earnings announcement? Well, let's take a look. We've got a little bit of time left to go, 18 days to go. We sold it for $7.70. Now it's currently trading at $6.17. Why might you roll ahead of an earnings announcement? To give it more headroom. So let's accomplish a roll here. Let's create a rolling order. We're going to roll this out, and we're going to roll it out to that 19 September expiration, and we're going to roll it up a strike. Actually, we're going to roll it up a few strikes here. We're going to roll it up to the 190 strike, just $5 more. And that's not going to help us because that's going to actually cost us. So let's roll it a couple of strikes. Let's roll it to the 187. That's not trading. Let's roll it to the 186. Not trading. Let's see what we have here in this particular case. Do we have a 187.5? We do. So we might have to go a little bit further out in time here to the 26th September. And now let's roll it to that 190 strike and see if we can get a credit. So this is a challenge. Let's roll it straight across to the 185 and bring in a little bit more credit, give it a little bit more time. So even if it does make a big move to the upside, we've got some time to accommodate that move. We're going to click on confirm and send, read through the order, make sure that we're aware of it. There's our roll. Make sure that we pay attention to any alerts that might be there. So what we've done is we've rolled it further out in time, given ourselves a little bit more time, a little bit less likely that if the stock does make a quick move on the earnings announcement, that we're going to be assigned early. So that was our bonus. Those are our four reasons, three reasons primarily in one bonus: close to expiration, deep in the money, close to the strike, or ahead of an earnings announcement. Those are three reasons plus one that a trader might roll a covered call, and how you do it. If you want to learn more, check out the Trader Talks webcast page. Remember to click on subscribe while you're here. Follow me on X at Ben Watson CS. Follow Brent on X at Brent Moores CS. We'd love to have you in all of our webcasts. So have a great day, everybody. We will see you again very soon. Take care. Bye-bye.